price of gold has absolutely skyrocketed in recent months. In fact, it's now worth around 50% more than it was at the start of 2025, and many analysts believe this trend is likely to continue, driven by factors such as the decline of the US dollar as the world's reserve currency and rising geopolitical tensions. But how exactly does the average person invest in gold? And what's the most cost-effective way to do so? Well, there's a couple of different options, each with their pros and cons. In this video, we'll run through each one, starting with the most obvious. Buying and storing physical gold as an investment has been done for literally thousands of years, and it's as popular today as it ever has been. A lot of people will do this through buying gold jewellery. However, this is a very cost-ineffective way of investing in gold, as you're not only paying for the value of the gold itself, but you're also paying for the craftsmanship of the jeweller and of the brand name of whatever it is you're buying. So if you're just interested in making an investment and aren't worried about having something that you can wear, then going for gold coins or bars is a much better option in terms of value for money. In the modern day, probably the easiest way to purchase physical gold is to go to an online broker. In the UK, you can buy gold directly from the Royal Mint and have it delivered to your home address. Or you could go to third-party brokers like Bullion by Post or Atkinson's Bullion, who tend to be slightly cheaper. Also, if you're in the UK, your best bet is to go for gold coins called sovereigns and Britannias, as these are exempt from both VAT and capital gains tax. These coins vary in size from the small half sovereigns and 10th ounce Britannias all the way up to the full 1 ounce Britannia. Now, although buying gold coins is much more cost effective than buying jewellery, there are still costs that you need to be aware of. Most importantly is the difference between the actual value of the gold within the coin and the price charged for the coin by the broker. This is known as the spread and is essentially the commission that the broker is taking. For example, as I record this, the price of pure gold sits at £3,041.84 per ounce. But if I wanted to buy one of the 1 ounce Britannias from Atkinson's Bullion, I'd have to pay £3,216.74. So this difference of £175 or 6% is the commission that they're taking. And this is quite a lot. I'm guessing more than you were expecting. It certainly was when I first looked. And this isn't even the only cost that you need to think about. For example, if you're planning on storing this gold at your home address, you might want to think about putting it on your home insurance. So there are a lot of benefits with purchasing physical gold coins. You can see them, they're not numbers on a screen, and they're much more cost effective than buying jewellery, but they are still quite an expensive investment. A commission cost of 6% is really quite high as investments go, and could be enough to put people off investing in gold altogether. But luckily there is an alternative which avoids the vast majority of these costs, and that is through investing in a gold ETF. An ETF, or exchange traded fund, is basically an investment fund which can contain a variety of different assets like stocks and bonds. It's exchange traded, meaning that everyday investors like me and you can purchase shares in the fund, and the share price will move based on the value of the assets which make up the fund. If any of you have invested in the stock market before, maybe the S&P 500 or a global index fund, then you've likely done this by purchasing shares in an ETF through an online broker like Trading 212 or Vanguard. A gold ETF works in exactly the same way, but instead of containing things like stocks and bonds, a gold ETF will contain just one asset, gold. So if you were to buy shares in a gold ETF, the value of your shares will essentially track the price of gold. If gold goes up by 10%, then so will your shares. And the real beauty of gold ETFs is that you can avoid these massive commission charges that you get with buying physical gold. The only cost is the small fee that the ETF provider will charge, but this can be as low as 0.1%. And if we compare this to the 6% commission we have on gold coins, we can really see the savings we're making. Okay, so how do we invest in one of these? Well, we first need to get ourselves on an online broker which have gold ETFs available. If you're in the UK, your best bet is to go to either Hargreaves Lansdown or Trading 212. Hargreaves Lansdown are a big, well-established name with really good customer service. However, they do charge a 0.45% fee for just having an account with them. Trading 212, on the other hand, are an online-only platform and don't charge any platform fees, and it's the platform that I use personally. But whoever you choose to go with, it's best to open a stocks and shares ISA, as this will allow you to invest up to £20,000 each year and not pay any tax on any gains that you make. Don't worry if you've already got a stocks and shares ISA with a different provider. You are allowed to have more than one. Okay, so once we've got our account opened, we now need to find a gold ETF to invest in. Both Trading 212 and Hargreaves Lansdown have a handful that you can choose from, and they're essentially all exactly the same, so you may as well just go for the cheapest one, i.e. the one with the lowest fee. And one of the very cheapest on the market at the moment is the iShares Physical Gold ETF with ticker symbol SGLN. This ETF has a fee of just 0.12% per year and is available on both Trading 212 or Hargreaves Lansdown. I'll put some links in the description if you want to read more about this ETF. You can read all about how much gold they hold and where it's all stored if you want to. Now, although investing in this ETF is way more cost effective than buying physical gold, you do lose out on having something tangible that you can hold in your hand, which is one of the main appeals of investing in gold in the first place. But for me at least, not losing 6% of my money through commission was enough to convince me to go for a gold ETF over physical gold. And going for a gold ETF would be the route that I'd recommend, just for the ease and the cost savings. That said, there's nothing stopping you splitting up your investment between some physical gold and some ETF shares. The beauty of platforms like Trading 212 mean that you can invest as little or as much as you want with no commission or fees. So if you wanted to put, say, 500 quid into gold, you could go for a 10th ounce Britannia for a little over 300 quid, and then stick the rest into a gold ETF with Trading 212. So hopefully this has been helpful. Please drop me a like if it has, and leave me a comment below if you've got any questions. I'll be sure to get to them all. Thanks for watching.